Hi, and welcome to the Choose FI Foundation's Educational Speaker Series, where we take topics from the Choose FI Foundation's pre-K through 12 financial literacy curriculum and break it down with expert speakers in the area to bring a little bit more information and ideas to the topic. Hope you enjoy it.
Hi, everyone. This is Rob Phelan with Choose FI International Foundation. I am here with Stacy Hart, who's going to have a talk with us today about credit and credit scores and building credit. Stacy, how you doing?
I'm doing great. It's a sparkling day in Central Oregon.
Good for you. I'm sitting in a storm in Maryland at the moment, so I'm a little jealous of your weather. So, Stacy, tell us a little bit about yourself. Like, what do you do, or what did you do, or tell us a little bit about your career.
So, I am an accidental banker. I was going to school studying retail and marketing and needed to raise some money to go on a national trip to participate in a DECA conference, which is a marketing organization. And one of my classmates, his mother worked in a bank, and so I was offered a job working in a bank in 1979, my freshman year of college. And I've been in banking ever since. And it turns out that I'm much better at that using my analytical skills than I would have been in advertising or marketing.
Awesome. So a huge wealth of experience in the banking industry, which is really why I wanted to talk to you today. So how has the banking world changed for consumers, I guess, since you got into the industry? Is it still the same thing? Is it changing all the time, or do the same principles just kind of hold true no matter what?
There are some common principles that always matter, and that would be the 4 C's of credit, which really you're trying to evaluate the person's ability and willingness and character to repay a loan. So that part, the human part, has not changed much over my 40 plus year career. The technical side of things has changed a lot. And it changes basically through regulation and improvements in technology. And that is very evident in the credit scoring models that are now popular and commonly used and updated very regularly.
Yeah. So I'm assuming that what used to happen, or at least when I look at movies that portray what loans used to look like, you would walk into your bank, you'd be dressed really nicely, you would have a private talk with someone from the institution, and you would essentially ask for a loan, and then they would kind of go through your own history and determine whether you were eligible for the loan or not, and sort of been replaced with a lot of technology. So being able to look up credit scores and credit history very quickly. So how important is this credit score?
The credit score drives everything in the financial world. Basically, it is rating how well you have handled credit in your history and what types of credit you've had and how successful you've been at managing those. And it tries to come up via artificial intelligence with a predictor of which people are going to repay and which people are not. There's always things that we can't underwrite for, like death and disease and pandemics and, divorce and things that can impact a person's ability to repay. But we have a better model for if everything's going well, here's your predictor score of this person's ability to repay.
Okay, cool. So the credit score, I guess, it's this number, and numbers between 300 and 850 if we're talking about a FICO credit score. And FICO is the, Fair Isaac Corporation.
Isaac Corporation.
Yes.
And that is the most widely used scoring model. But even within FICO, they have many different scoring models, some of which are iterations from when they first started the scoring 25 or so years ago to industry specific type of scores. So there would be a mortgage score may have different components than, for example, an auto lending or credit card score.
Oh, okay. And then I know that there are the 3 credit reporting bureaus, the 3 major ones at least, Experian, TransUnion, and Equifax. And we noticed that like those are the three that should have your credit report and then basically produce a score from your credit report, but they can all come up with three different scores. So I'm guessing there must be a lot of different ways of calculating credit score. Is that right?
That is correct. And part of that is because each of those credit bureaus gathers information from credit issuers, and not every credit issuer reports to all three of those bureaus. Some report to all three. Some may only report to TransUnion. Some may only report to Experian or Equifax. So that's one of the reasons that you will see differences in the scores based on the different bureaus.
Okay. So I wanted to talk a little bit about like what the number actually meant. So from a I guess a lender's perspective, if I'm walking in with a credit score of say 650, what does that tell you about me?
650, I think, is something where we would be looking more closely at why is it 650? What are the components that make up the 650? Because there's part of it that's just a score and a predictor, but there's also part of the interpretation of the overall credit history. So you're going to be looking at, okay, is the reason it's 650 because the person has limited credit and they don't have a long history of credit? Or is it because they've had late payments or judgments or bankruptcies or collections? So is 650 due to a low score for derogatory reasons, or a low score because they don't use credit very often or haven't had a long history of using credit? They may be new to the credit world.
Gotcha. So the graphic I've just pulled up here is the kind of breakdown of what is a very poor, fair, good, very good, and exceptional credit score. And then there's also a breakdown of what percentage of Americans supposedly have this, and the status coming from Experian, which is one of the credit reporting bureaus. So the person with a hypothetical 650 score is falling in on the fair range. So they're in like the bottom, I guess we'll say the second fifth of the score range. And you're saying that it could be due to poor handling of credit, or it could just be a lack of like credit history, which is probably where a lot of my students are going to be coming in. If you don't have any credit history, like you've never borrowed money, what's your credit score?
Generally, we will come up with a unable to score error exception in that case, because if you have had zero credit for anything and they can't pull up any history, then they cannot score you.
Okay.
So it's more likely that if you had a zero credit score, you would need to go with an alternative underwriting method for obtaining credit, because they can't do it on a scored model using the technology of FICO.
Awesome. And that actually was a question for one of my students, Braden. He asked, are there alternative ways to prove that you would be a reliable payer? So you're talking about now a manual underwriting. What are some other things that, say students can do to show that they have the ability or the personality to repay debt?
I think that one option, which I have seen, is where they get a card that is either secured, where they put up their savings account of $500 and they have a provisional credit card, and it's reported to the bureaus as they pay, and it usually has a low limit, like a percentage of the amount of their savings account. So secured credit cards are one method.
Okay.
Another option would be co-signed with a parent credit card, or being put on as an authorized user on a card of a family member, so that you have someone guiding you. Because the worst thing is to just get out there and open a credit card and go wild, and then find out that you can't cover the payments, because that will damage your credit very quickly.
But say I am walking in and I want to get a auto loan. I want to buy my first car, but I need a small loan to help me out with it, but I don't have any credit history. So like opening a secure credit card is an awesome way to start building a credit history. And we're going to talk about that in a couple of seconds. But like say I have no credit score, but I want a loan. Is there anything that you could look at as opposed to like a credit score that I could use? Like, can I say I've paid my phone bill on time for X number of years, or I already pay rent somewhere or something like that? Can I use other information to help you guys get a picture of me?
Yes, in the manual underwriting world, that's exactly what we would do. We would look at utility payment history, rent payment history, any other types of history. We also look at job history and stability, because that's critical to being able to repay, is having an income stream that covers, you know, the payment and your living expenses.
Okay, good to know. All right, so let's talk about the factors that make up like a credit score, like what is used to determine credit score. I'm going to change the graphic quick. Can you kind of walk me through these kind of 5 main factors that make up a FICO score?
Okay, I'm going to start with the largest one, which is payment history. And that's critical because that tells you, you know, how much credit has this person had, what kind of monthly payments have they been able to make, those payments on time, and how long a period of time have they actually been involved in handling credit.
Mm-hmm.
Credit history is 15% for the length of credit history. And a credit report generally reports all of your history, but they'll only show the payment history portion for 7 years. So if you've had credit for 7 years, you're going to score higher than if you have only had it for 1 year.
Okay, and with
the credit mix,
just on length of credit history, I think one thing that I didn't realize when I started was that, say like my oldest credit card is 7 years old, but my length of credit history is not just 7 years, right? Like, so every time I open up a new line of credit, it almost dilutes down my credit history. It's almost like an average is taken. Is that right?
Well, actually, I have seen on my own credit report and borrowers that I've worked with that sometimes, even though they're only reporting the 7-year payment history, the actual open date of the card could be 10 or 20 years old. So that would show a length of credit history, in my case, for 30 years, but they're only showing the payment history for the last 7 years of that time frame.
Gotcha.
And age of credit, that's why it's really important if you have it, when you first open a banking relationship and open a credit card, and this is fairly common with people's first banking relationship, is kind of the grandfathered in relationship. And those are the ones that, as long as they have good credit terms and they aren't charging you a ton of fees, it's important to keep those open because they will be the foundation of your credit history.
Yeah. So like that first credit card you get, like for me, it was a very basic Capital One card. I still have it because that is my longest credit history on record. So actually my student loans have been paid off. And since they've been paid off, are they going to disappear off my credit score?
They will not disappear until after 10 years. And then they may drop off. They'll still show up on there as paid trade lines. And so it'll show when they opened, what your monthly payment was, and then the date of last activity, and showing a zero balance if you've paid them off.
Okay, so it's not like you should keep your student loans trickling along as a little pet for as long as possible just to get that credit length, right?
Absolutely not.
Get rid of
it
those
is
things.
Better to pay them off, get out of debt, because you are just prolonging your inability to then invest and grow your wealth.
Okay, good to know. Good to know. All right, so we had another question that came in from Lindsay, and she wanted to know, like, what is the fastest way I can go and build credit? And we kind of hinted at the secured credit card, but are there other ways that we could do that?
Being added as an authorized user on a family member's card is a way to develop a credit history fairly quickly, because in most of those situations that I have seen, they show the shared credit history immediately, even though you may not have been the authorized user on that card for an extended period of time.
Okay.
But it is a risk to the parent, because they have to monitor and make sure that if you're added as an authorized user, that you're handling credit responsibly, because what could happen is if you run up their bill, it could negatively impact their credit score, because as you see in the graphic, 30% is based on the amount owed. So if you have a $10,000 credit limit on a credit card and you run it up to $9,500, that's going to negatively impact your score based on what we call credit utilization rates. And you would want to keep your credit utilization rates as low as possible. And so it aggregates all of the revolving debt that you have, so credit cards or store accounts, that type of thing. And so they're going to be looking at, if you have 50,000 total credit available to you and you have less than 30% of that owed, then you're going to look like you are managing your credit more responsibly.
Okay.
Fortunately, it's an aggregated thing instead of one card at a time. So if you have one card that has a $9,500 balance on a $10,000 limit, that would be extremely high utilization. We'd call that maxed out.
Okay. Now say, like, what if I was thinking, oh, I'm going to be smart here. I've got maybe like $5,000 out on a $6,000 credit limit. So really high credit utilization. I'm going to apply for like 10 credit cards. If I get like a credit limit of 5,000 each of those, like that will really drive up the amount of credit I have available and reduce my credit utilization. That'll work, right?
Well, that does reduce your credit utilization. However, new credit is also looked at if you are opening a bunch of cards at once, especially, or even in a 6 to 12 month period. That's a red flag to a lender, because we look at, okay, so far he's shown he can manage a $5,000 credit limit, but we haven't seen how well he can manage a $50,000 credit limit. And so that kind of speaks to the length of the credit history, the amount owed, and the new credit all dovetailing. And we want to see if there's a gradual increase, then we can see how over time someone manages. But if there's just a huge increase in a short period of time, we have to wait and see, watch and see how they perform with that.
Okay. And I know when you apply for a credit card, an auto loan, a mortgage, basically any sort of loan from an official lender, there's this thing that happens called a hard hit on your credit, and there's also soft hits on your credit. Can you explain what those are?
A hard hit is when you have actually applied for new credit, and they're going in and pulling your credit for the purposes of determining whether or not they're going to approve you for that specific loan. So that's a hard hit. A soft hit might be you're opening a savings account and they just want to make sure that you are financially solvent, and they want to look at you first. Or a soft hit could be an insurance company pulling your score to see, okay, do I need to raise their premium based on their credit score or lower their premium based on their credit score? Another reason for a soft hit, that we also call them sometimes marketing pulls, is where a credit card issuer is looking at who is a good target customer for me. I want to expand my market share of credit cards. And so I'm going to look at people who have, let's say, Capital One cards, and see who might have been one of those beginning Capital One card holders and how they've done since then. And maybe now is a good time for me, American Express, for example, to market to that person and send them out a direct mailing or send them out an email targeted at getting them to open their account with us.
Yeah. And it's really important to note on that new credit part of the FICO score that if even if you don't open a line of credit, a hard hit or an inquiry on your credit is something that does count as well. So
It
if
does.
like you are applying for lots of different credit and getting denied, so you went to 3 different credit card companies, applied for credit cards, you got denied, each one took a hard look at your credit, it will show up on your credit report and your credit score. And I believe it stays on your credit score for 2 years, correct?
2 to 3 years is what we look at. And I'd say when we're looking at mortgage lending, we're looking at what have they done in the last 90 days to 6 months. But the 90-day period is we want to know, have they applied for credit and perhaps been granted credit that hasn't been opened yet, but may impact their debt to income score because they bought a new car to put in the driveway of their new home that you're looking at financing.
Yeah, I remember when I was applying for my mortgage, our mortgage provider basically said, don't change jobs right now. Don't go and buy a new car. Don't get a new credit card or close any credit card accounts. Basically, don't mess with your credit score because it will affect how, like, the rates that we're going to be able to offer you or whether we're going to be able to offer you a loan at all.
Absolutely.
But on the flip side, if you are shopping for a car or shopping for a mortgage, it's okay to approach multiple lenders at the same time. Like if all the hard hits on your credit are within a smaller window, it's looked on a little more favorably, right? That people are actually shopping around for credit as opposed to it being like a red flag.
Yes, because if you've been to 3 car dealerships and we can see that you were shopping for a car for a weekend, we usually know that you are buying 1 car, not 3 cars. And so then we would want to see verification that, okay, here's the car, here's the monthly payment that you have. How does that fit into your debt to income ratio for, let's say, a mortgage? Or are we looking at utilization in determining a credit limit on a credit card? We're still going to want to look at what are your monthly payments.
Gotcha. Okay, so I want to move into a new question from one of the students, and this one comes from Seth. He asked, can you maintain a good credit score by not using credit? So you've worked really hard, you've got your credit score up. Can you now just stop using credit and it will stay at a high level? Or do you have to continue to use credit to maintain a high level credit score?
I'd say you need to maintain it by using it, because if there's no history for a period of, a year or 2 or 7, then your score will drop. So what I have seen, for example, in my household, my husband does not use credit at this point in his career. He's retired. He doesn't have the need to use credit to purchase things. So he has 1 account that's open as a credit line, and it's, it gets regular use. We put our gas on our Costco card, pay it off every month, and it keeps his score high. So that is probably the most important thing, is to have regular use so that they have something to score.
Yes, and a lot of like credit cards will, if you don't use your credit card for a period of time, they may close the account, or they may send you a message, say, look, it doesn't look like you're using this card anymore. We're probably going to close it if you don't use it.
Yes, and I've had that happen a lot this last 12 months, where a card that maybe I used for a single purpose thing years ago and I haven't used it since, if there's not enough activity, it's not worth it for them to keep your account open. They want you to use the cards that they've issued to you. And if you choose not to, they'll either reduce your balance because you're not utilizing it, or they'll simply close the account. One of the ones that's just notorious for doing that is Old Navy, which is, a great place to shop, and they give you a great discount when you open a card with them. But if you don't use it for 90 days, they close it.
Oh, wow. I didn't know that.
And the next time you go into the store, the only way they'll give you the discount again is to open a new one, which is not a great business model.
No, odd thing for sure. All right, so let's go one more question from students. This one comes in from Sammy, and she asks, when you apply for student loans, does credit score matter? And we both kind of chatted about this beforehand, and we were like, you know what, I'm not really sure. So I did a quick search just to find out. And it turned out that if you are a student applying for your own student loans and you're applying for federal student loans, so you're going through the FAFSA application, your credit score does not matter. So you will be entitled to get loans regardless, and it should not affect the interest rate. An exception to that rule is if you already have student loans and you have defaulted on those student loans in some way, so you have not paid them back. So if you have a history of not paying back your student loans, they're not going to give you more. So say you wanted to go to grad school, but you had defaults on paying back your undergrad loans or something like that. The only time your credit score will have an impact is if you're applying for private loans. And if you're applying on your own, then you will need your own credit score. If your parents are co-signing with you, then your parents will need a good credit score. So it was a great question. It was one that I didn't know the answer to, and you didn't either. So it was like, all right, well, let's go look that up. So that was something I learned today.
As I did.
Yeah. So Stacy, is there any other last bit of advice, information you would like to share with, high school students who are just about to start on their credit journey? So we know the average American has a little bit of trouble with managing credit. We get in a lot of trouble with credit cards in particular. And is there any advice that you would want to give to high schoolers who are just about to start? They haven't made any moves yet, no errors, no successes. It's like blank slate. What would you advise to them?
The advice that I give is limit your use of credit. And when you charge something, make sure that you can pay it off within that cycle. That saves you a ton of money on interest. It keeps you from getting into trouble. If you treat your credit card like a debit card and only spend on it when you have the money to pay for it, then you will be far more successful than running it up and then trying to figure out how to pay for it later.
All right. Well, Stacy, thank you so much. Is there any way that people can get in contact with you if they have questions?
I have a Facebook page and a blog, and it is Heart on Fire: Lessons on Money and Life from an Accidental Banker.
And that's Hart spelled H-A-R-T, right?
Yes, H-A-R-T.
All right, Stacy, thank you so much for joining us today.
Thank you.